There is more and more reliance on machine, predicting patterns in the markets and creating forecasts than ever before. The computing power of sophisticated software, which sometimes costs millions and more to put together and perfect, is getting popular, and for a reason. You can go back decades and even centuries, run innumerable scenarios, and learn data that used to take years to collect in a matter of a few hours. Today's guest, Charles Nenner, has used this method and systems throughout his career. He is now predicting a 70% market crash. Here is his interview with Wealth Research Group.
Welcome to the Titans of Industry show. Charles Nenner is our guest today. Charles has developed systems over the decades which he uses to make forecasts on various asset classes. It's very interesting to listen to him. He's been a returning guest on our show because he finds patterns and makes the case that history repeats itself, which often it does. There's a famous quote that says, history doesn't necessarily repeat, but it surely rhymes. And that is part of the theory behind his research, his investment predictions. And so, Charles, thank you for joining us again.
Well, it's great to be here. I'm just not a poet, so it doesn't always rhyme, but I'll do my best.
we last chatted at the beginning of 2019, so I want to know, how's 2019 treating you in terms of the portfolio and some of the forecasts that you've made?
Well, as you maybe remember, we went totally out of the market in January 2018. I explained why. That was very simple at high. And after we got to the low, we start trading up and down, and we still didn't get back, and we're almost not invested in the stock market because it's right again at the price target of S&P 3020, 3030. My cycles don't show me that I should be long. An interesting observation is that the the small investor is very bullish. I wrote a couple of days ago that the call buying in the indices is the highest I've ever seen. And the bigger investors are selling, and the small investors are buying, which usually from a contra indicator point of view is not very positive for the market. So a lot of things are lining up again. And as long as we don't see a real upside break, and it doesn't have to be much, 3-4% would do it, but I don't expect it, we're out of the market.
Charles, which indicators do you look at to determine if retail investors are bullish and smart money is bearish?
Well, I look at the put-call ratio. I look at the big blocks and small blocks that are being bought and sold in New York Stock Exchange. You can see, for instance, that big firms buy, let's say they want to get rid of a couple of million IBM. So they buy 50,000 IBM in the market. The IBM shoots up, and then they sell 2 million at that price. So you see them maneuvering how to get out of it. Then you can look at articles. Usually when the big guys want to get out, they promote all kinds of articles. It's great, and the markets go much higher because they have to sell to somebody. And then you look at the what they call the indicator. I'm sorry to say that the dumb money against the clever money, and they really can plot it in such a way that you see that what they call the dumb money is getting super bullish. There's almost no fear in this market, and the big investors are the ones who are selling. Now, this based together that we reach a price target that we came up like 10 years ago, especially today, for new subscribers, we showed how to calculate it, and the fact that cycles are topping. That's our input, that's our work. It makes us very defensive over here. And we have, for people who are still invested a little bit, we have a long position in the VIX just to protect them from the down moves.
You know, you talked about how big firms promote using articles. Can you talk a little bit about that so people can understand what you're implying?
Well, for years there was a column in the Wall Street Journal. It's not allowed anymore, and the column was called "Heard on the Street," and they went always to so-called professionals, and they were professionals, and they were pushing the stocks that they had to sell until it became very clear, and they said this is not allowed. So the question is, when we had the big crash and it bottomed in 2009, who do you think was buying? Well, The small investor was not buying because he lost almost all his money. The clever people were buying, sorry, because they knew that with the Fed and the economy and everything would pick up. And so it was very simple to buy at a cheap price. Now they have to sell, so they have to create a market, because the clever money doesn't sell to the clever money. The clever money sells to the small investors. So now they have to get the investors, small investors, ready to take it out of their hands. And that they do by appearing in the media and in the newspapers and coming with all kinds of stocks and making arguments that are not correct, like the Fed is going to lower interest rates, is going to keep the market going. Well, in 2000, they were lowering the interest rate from 6.5 to almost 0, and it didn't keep the market going. In 2019, it keep the market going, and a lot of examples that if the economy is turning over and becomes weak, when the Fed is lowering interest rates, usually the market goes down for 30-40%. But since small investors don't have the time to go and study the whole history of financial markets, they don't know that. So they get caught in all these stories.
You know what? I just heard BlackRock CEO. Obviously, BlackRock is the biggest asset manager in the world with about, I think, 6.4 trillion under management. And the founder CEO said that it's a mistake to be in cash and you should go along the markets right now. The S&P 500. It is interesting because not only are we at all-time highs with these indices, but the Federal Reserve is talking about the reasons to lower rates as being outside of the U.S. And I find that very interesting that the Federal Reserve, the Central Bank of the United States, says, look, the problems are mostly in Europe or Brexit or such and such, and that's the reason why we need to lower rates and not something domestic and internal. I find that very interesting from the Fed. But I do want to switch gears a little bit with you and ask you about something else, gold stocks, etc. We've been having huge gains, in our newsletter with Franco-Nevada, with Royal Gold, with Sprott Inc., for example, some of the blue chip royalty companies and bigger names. But, they're up 40, First Majestic Silver is up 55% in the last 45 days. Been amazing. But we still don't see any interest in any of the junior miners, the small cap miners. We have no liquidity. People feel that the precious metals rally that we're seeing right now is temporary. It will die off. They're comparing it to 2016, where we saw a 8-month rally, basically. What are your cycles telling you? Is this a bull market? Is this a rally? Is this fundamentally driven? Talk a little bit about the gold and silver is very interesting.
Well, I don't know when it was the last time I was on, but we were long gold for the last $200. And our price target was $14.55. We reached it and we sold our gold position. I think we're in a bull market, but for the moment it has to trade sideways based on cycles. Gold will go to 2,500, but the timing is very important because you can have very, very volatile down moves and everybody's stopped out again. But gold is going up. Now, another interesting point is, and I just want to mention it, that the so-called people who don't want you to buy gold until they're fully loaded up on gold will say, yeah, there's no inflation, so we're not going to buy gold. And I just want to mention that 50% of the bull markets in metals come in deflationary periods, not in inflationary periods. And what we're going to have is, we're going to have a deflationary crisis with low interest rates, and there will be nowhere to go except, to buy some metals. Now, what we talk about is that silver is still behind, and silver really has to catch up. There's a silver-gold ratio. It has to give a buy signal, because without silver, gold usually doesn't have a long-term bull market. Again, the bull market has started, but now we took profit, and we're looking for some weakness starting in about a week. And then when our cycle bottoms, we're going along again.
Can you talk a little bit about the gold-silver ratio and what to look for?
Well, it's another cycle that has to bottom and another breakout that we need. And so we're looking, just simply waiting until it breaks out. We know exactly what to look for. And once the silver-gold ratio breaks out, then we would say we have another confirmation of a long-term bull market in gold.
Do you have any forecast on the coming presidential elections in the United States?
Well, I would say this. I think the economy is going to drop dead next year, and the stock market is going to be much, much lower. So based on that, I don't think Trump is going to win. I think what the Democrats are proposing, and I don't think they really believe in what they're proposing, would just kill the whole economy and the whole of the United States. As I've been teaching people, there's something called the Kondratyev cycle. Kondratyev was a professor in Russia. Actually, he was killed because I think in 1915, 16, 17, somewhere there, he said that the capitalistic system is going to be stronger than the communist system.
Very famous story.
Yeah. So, but he says every 60 years, which was a cycle, another continent takes over. So Europe already is down. America is going down, and the new wave is India, Singapore, China, Australia over there. And it's just very interesting to see how that works, how the United States is destroying itself. So I don't think it's that important who's going to win. I think they will continue to destroy themselves. If it's Trump, they continue to destroy him so he can't do anything reasonable. And if the Democrats going to take over, the destruction is going to be even faster.
You know, one of the things that that I find interesting is that there's tweets by Trump, and there are comments from the Federal Reserve, and they all are trying to make sure that everybody understands that the dollar is stable, it's the reserve currency, etc. Do you think that that kind of a talk is just their way of projecting fear that other countries are looking to de-dollarize and move away from a reserve currency that is the dollar?
That's a difficult question. I know as much about that than anybody else. What I do is I try not to make interpretation. So if the cycle for the dollar is up and it starts moving up again, the dollar goes up. And then, in a couple of weeks, couple of months, we understand why it went up. Right now, we don't know. And when it hits a price target, that's the top of the dollar that goes down, and then they're going to talk it down again. So I really don't know much more about this issue than other people.
You know what, and that leads me into my next question. I know you love cycles. The system you've developed is all about cycles. You first of all look at what the system says, and then you interpret, why it's up or why it's down, etc. But initially, you look at either a buy signal or a sell signal from your systems. You've developed those systems. You've created them. And obviously, I'd like to know if you compare your systems and what they print out and, their buy signals and sell signals with other systems, other commentators, other analysts, etc. Or do you go from the standpoint that this system is the best, and therefore I should only follow whatever the system tells me?
Well, since a year we have an intraday service. Comes out once or twice a day. It gives the exact hour when something goes up and how many hours it goes up to the minute, and exactly how many points it goes up and down. So I don't think I have much competition. So I don't really look at the competition. I just do my thing. And I never heard somebody say, Mr. Nenner says tomorrow at 3:10, the dollar's going to bottom, but I think it's 4:10. Nobody says that. So I have no competition. They just don't speak up. What I only hear is, I don't know, and nobody knows. So they're out of the loop, because if nobody knows, nobody keeps you responsible. So we say we know, and we write down what we say. And for people, it's very easy to check if our dates and our levels are correct or not. So I don't look at anybody else. And one of the reasons is that I could be influenced by what other people say. You look at this out of interest, but if 9 people say the market goes down, who am I to say the market goes up? I think I'm right based on my cycle work, but I don't have the emotional problems if I don't have 9 people saying something opposite to me. So I don't watch what other people say.
Very interesting. I want to ask you one final question, and that and that is with regards to um, the fascination with the Libra coin with Facebook. Do you have any opinion on this subject? What do you think about it in general? And do you think that it's something worth researching further? Is it something that will impact the world's currencies, the world's economy, markets, etc., or is it a marginal, minuscule subject?
Well, we did since a half a year. We're doing the forecasting on the Bitcoin. It's very successful. Nobody can say, well, you have to look at fundamentals because there's no fundamentals. So we got the cycle top, we got the cycle low. By the way, the next cycle low is August 7th. Look, going back to your questions, I have no idea. I just know about markets, if they're going up and down, how much they go up, how much they go down, when they top, when they bottom. And the rest, I read the media, I know as much as anybody else.
You've called for resuming the 1999 levels for major indices. You've called for major crashes in the markets. Right. Do you still feel the same way? Is the cycle the same as it's been? Is the system pointing to the same thing? These are major. Well,
let's talk something very simple. If you would ask your broker, he says, you know what, the market goes up about 7-8% a year. Correct? You always hear that. Now the problem is,
yes,
that's based on the medium up move. So if you take the market from 1870, there was a big low then, and you do an ankle of 8%, a line of 8% going up a year, then it moves around that line, below it, above it, on the middle. The problem is I didn't look at it lately. I think we're 50-60% above that line. So in order to get to the medium of 8% a year longer term, we have to go 60-70% below the line. So to say that we're already 60% above the average, but we expect the market to go up 8% the next year and the year afterward is totally nonsense. So not looking at my work, if for 100 years the average gain of the market is 8% and you're 60% above the 8% line, then you have to go 60% below, and then you get only to the medium of 8%. Now, if it goes lower, if you want to just go a little bit below that, you go much lower. And I just want to mention one thing that people maybe don't remember, that bear markets usually end only when there's a PE of 5-6. And we haven't seen that for a long time, and people forget. We have the same thing in the bond market, although I think the bonds are still looking very good. But most brokers remember bull market in the bonds for the last 30 years. They don't even know that bonds can go down. So all the information that people get, we look on face value and we write about it and we show people how it's not correct. So they have an independent idea about the facts and not listening to the media who only wanted to go long. I had an eye operation. As you maybe know, I wrote about it. And for 6 weeks, I was sitting with the curtains closed in my apartment in Miami. And I was linked to CNBC. And the interesting thing is, in 6 weeks, I didn't hear one person say maybe you should sell something. It's always a buying opportunity, because that's the way that they connect to the people. No, but not one. Try to listen and try to get one pundit who says maybe you should take a profit. Nobody says that, because they're not going to invite you anymore. In Goldman Sachs, when I was there for 50 years, they did a research and it came to the conclusion that if you're an optimist, you make a much better career in Goldman than when you're a realist. So all these things, give people a false feeling of safety and being bullish for no reason. And we try to fight that. It's very hard, because if I say sell and 100 times a day they hear buy, they get influenced, like me also. And it's very hard for them to stay on track.
It's so true, though, that the bias is always to buy on the media. I haven't watched mainstream media, I think probably 16 years now, but every time that I'm sitting at another investor's house or something like that, and he's got the CNBC running or anything like that, and it's always on autopilot. These people, they listen to CNBC all day long, like all market hours. It's just on, and it's always about another stock and another buying opportunity, another stock. It's endless. It's just amazing. I do want to ask you, how can people follow your work and check out more of what you have to say? What's your products, your services, etc.?
Well, you can go to our website. It's charlesnennerresearchcenter.com, charlesnennerresearchcenter.com. You can sign up. You get it, I think 4 weeks, 5 weeks, I'm not sure, for free. You can also take a look at the intraday service if you want to be more on top, and see if you like it. If you like it, you can take it. If you don't like it, but you can take it month by month. So you can pay for a month, 2 months. You don't like it, you stop it. These times are very, very important times. I would urge people, it doesn't cost you anything. Just take the research. If you like it, just take it for another month, and it's going to be very helpful.
Charles, thank you very much. I do want to ask you, can you tell us a little bit about some of the books that you recommend to any investor starting out right now? If there's any book or anything like that that you think would help people starting out right now?
Yes, there's a book called The Long Wave. It's a thick book. I don't think that people have patience to read about it. It goes about 200 years of financials, up and downs, and how it worked. There's another book that was very important for me that was by Professor Schumpeter. It's called Business Cycle. He believed in fixed cycles. He also believed that there would be a crash in 1929. He was right about it. And then if you're in technical analysis, there's so many books, but we these days have a webinar, and we have a webinar to get people through all the ups and downs of reading all these books about technical analysis. And in the end, it comes down to only a few indicators. So if you would subscribe to a webinar, you don't have to buy the books, and we make it very simple for you. I mean, it's difficult to study it, but 90% of what people write is you don't need. So I would say try the webinar, and on the webinar I can also advise some books, but it takes much shorter time to become a professional investor if you listen to our webinar.
Charles, thank you very much for taking the time. Really enjoyed it, and we'll definitely do this again.
Okay, be well.
Thank you.
70% or not, you must be prepared. Go to wealthresearchgroup.com/reset to understand how this debt economy could blow up, and to wealthresearchgroup.com/dead to learn how the dollar's role as reserve currency is being challenged. Make sure to tune in to Wealth Research Group's upcoming interviews as they continue to educate on what's really happening with our economy.